Contrasting Viewpoints with Ray Sclafani and Mark Hurley.
Ray has been one of the leading consultants in the financial services industry for many years, and Mark has annoyed countless people throughout the wealth management industry over the last 25 years with the white papers he has written. Today, they are going to provide their insights into what is really going on in the industry, some of the more absurd things they've seen, and also for anyone in this industry, some issues they should be thinking about as they try to build their business.
Mark, it's great to be back with you.
That's awesome. Great to see you again, Ray.
Okay, Mark, we got a lineup today that is chock full. So maybe the greatest regulatory change to our industry. A journalist, Bethany McLean, some may remember, sounded the alarm bell on Enron, has sounded yet another alarm bell. Aggregation software and the pressure being put by the regulators on advisors today serving clients. Growth matters. Well, maybe not to most of the industry, apparently. And another fact check story from RIA Biz. Can't just believe this. We'll get into that along with our main topic, what's going on with M&A. What do you say we get started?
Outstanding.
Okay, so let's hit first story from CityWire. The first step in a process, the SEC finalizes changes to customer data protection rule and amended an existing regulation regarding protection of client information. This may be the biggest change regulatory to our industry ever, April 2022. The proposed rule came out in August of 2023. It was extending the comment period, and we're getting really the first step here. This is more of what's to come with the SEC. Take us through what's really going on with cyber and with this issue.
Absolutely. I think what came out in mid-May is really just a small part of the bigger changes that are coming. The Regulation SP has been around for, I think, 20 plus years, and all they did was amend it. They wanted to make clear, particularly that if you get breached, you're going to have to disclose to every client if any client information is taken. In other words, they put a duty on them to say, as Chairman Gensler said, if you got a breach, then you got to notify. And this is consistent with what the SEC's done and everything else, but it's really a small part of the bigger change that's coming. In April 22, as you mentioned, the SEC proposed a host of cybersecurity rules. They extended the comment period last August, and it's really just sort of waiting to get finalized right now. But these rules put wealth managers at the center of the cybersecurity issue. They don't distinguish between getting breached directly or indirectly. In other words, the SEC doesn't really care. They just say you have to have adequate cybersecurity, and if you improperly certify as to their adequacy to the SEC, you should expect an enforcement action. They even say that in the proposed rule, which is really unusual. And they're going to require a bunch of disclosures. One of them, for example, is you're going to have to disclose the counterparty risks that you have from a cyber standpoint to all of your clients from using your service. And an obvious one is, what if you get breached, and could they steal some of your information, and could they steal some of your assets? What's a much bigger issue, I think, for a lot of wealth managers is a hidden counterparty risk is that you can't use an advisor's services without having independent custodian or brokerage. And the agreements the client has to assent to in order to do that are breathtakingly one-sided, not in the favor of the client. Effectively, if the client is even indirectly at fault, they're not getting their money back. And this has happened already in many instances that we've come across with our company. The other thing they're saying is if you get breached, you're going to have to self-report. In other words, normally when you have a problem and you hope the SEC won't catch it during their once every 3-year exam or whatever it is when they come in to look at you. Here, you have 48 hours to self-report to the SEC. And then life gets, shall we say, fairly interesting. You have to notify every client this has happened.
Current, past, future.
Yeah, now it becomes a permanent part of your record, and you have to tell them what happened, why, what was lost, et cetera. And even if you don't get an enforcement action, I like to call this the face tattoo of wealth management. Nobody wants this. So, and quite candidly, most of the industry is utterly somnambulant when it comes to this.
Well, and it's my understanding, too, larger entities which include RIAs over $1.5 billion or more in assets under management, are going to have 18 months once the rules publication in the Federal Registry to comply.
Yeah, well, this is just, to be sure, this is just on the Regulation SP amendment. The bigger rules, which have yet to be finalized, they've not indicated how much time they're going to give people to do this. But let's sort of think about this. Every advisor has two things that cyber criminals want to steal. They want to steal client information. Identity theft is a $54 billion annual industry in the United States. And the other thing they want to do is to steal client assets. And in either instance, if you're an advisor, this is really, really bad news if something happens to you.
Right.
And there's two real naivetes that are out there. Number one is this is a technology problem. This is not a technology problem. Yes, you got to have good technology. But the largest attack surface for any cyber criminal is where humans intersect with technology. And the most easiest one to get to a wealth manager today is through their clients
or their team.
I'm sorry?
Through their team members.
Yeah, or through employees, particularly ones working remotely.
Mm-hmm.
And who doesn't work remotely now? The second myth I've heard about is I don't want to get involved in the personal cybersecurity of clients. I prefer not to do that or of my employees.
Yeah, good luck with that.
Oh, good luck. You know, the cyber criminals are like laughing their heads off when they hear that.
So here's what's interesting. This is just a preview of things to come from the SEC. Gessler made it clear that cybersecurity is a priority, and the elephant in the room is the rule proposed in 2022 that's yet to be finalized. So what's your expectation in terms of timeline on this, and what should an RIA do today?
I'm surprised the rule isn't final yet. The people who follow this closely had thought it'd be like December or January. The rumor, which, who knows if it's true or not, is that there's a vigorous negotiation going on between different units within the SEC who regulate different entities that be affected by this. But the proposed rule is consistent with everything else the SEC has done, and Chairman Gensler has made it clear this is a very, very high priority. So if I had to guess, sometime this summer, and then there'll be 4 months, 3 months, 6 months to get your act together. But they didn't give that much time to public companies, and they made it clear this will cover all registrants. Period.
So more to come on this story, and we'll be on top of it. Okay, let's move on to the next story. Business Insider got my attention, and yours too, with this story from Bethany McLean, the journalist who uncovered the Enron scandal. And the title of the article is "Inside the Growing Alarm over Blackstone's BREIT real estate fund." Very commonly for privately placed REITs, although the new rules forcing lots more accurate accounting. Where there's smoke, there's fire. What is she reporting about?
Well, first off, if you want to have the greatest nightmare for anybody who's either running a public company or an investment fund is to have Bethany McLean call and say, I think something's wrong. Bethany McLean is a true journalist. She is one of the smartest people you'll ever meet. She used to work in M&A at Goldman Sachs.
Yeah, she's a former banker.
You're talking about someone who can dissect a balance sheet with her eyes closed. And when she went after Enron, oh my goodness, they threatened to sue Fortune. They threatened to sue her. They did every possible thing you could, and she didn't even flinch. I think if she's onto something here, which I would be surprised if she's not, I think you're going to see widespread scrutiny on all private REITs. The way the regulators typically work is they kind of ignore stuff, and then some journalist stumbles onto something. I mean, keep in mind, Bethany not only put Enron out of business, she put one of the biggest accounting firms in the country out of business because of this. So I think there's a lot more to come from this.
So if advisors have clients invested in these kinds of assets, what kind of questions should they be asking?
Well, I think the fundamental question is how is the valuation being done? Because what Bethany's complaint is not that there was anything fraudulent in terms of what the investments were. She just said, look, you went in and
valuing them.
Yeah, you bought the stuff at the top of the market, and now you're telling me it hasn't gone down? I mean, come on, who are you kidding?
Okay, so more to come on that story, and we will follow that one closely. Another article over the last month that got my attention was, let's talk about aggregation software. It's a tool that makes it easy for advisors to use. Pantera was called out. It's the FA software for 401k management, but Pantera is widely used. The ruling affects others as well, including Envestnet's Yodlee, Morningstar's By All Accounts, all data from FinServ, formerly called CashEdge, and then, of course, Pantera. So this is going to affect every advisor industry-wide.
Yeah, and this is a classic problem with regulators in that you have a federal regulatory structure, but then each state has their own regulators. And this is being driven by the state regulators. It started with Washington State. Missouri is the second one to sort of hop on board on this. There's this tendency for a pack behavior of regulators. I once served on a public company board and got to watch this involving a financial services company. And the state's attorney generals at some point get involved if they think there's an opportunity to get money. The question seems to be, because it's kind of unclear what they're so upset about, but I think they're concerned about advisors getting paid on assets that are in retirement plans for advising on them. I think we really cut through the core.
Even if that's the core issue, that's not what's being tackled here.
Right. Well, they're claiming that you shouldn't have the credentials to get in there in the first place, even if the client gives you the credentials. And again, it's anything with state regulators tends to be a little bit more muddled. The big issue will be at some point does the SEC step in and say we want to take over this issue. But the state regulators can cause a lot of brain damage for people.
Well, and state by state, it's a very different issue. You've been a federal regulator.
Much to shame of my parents, briefly I was a federal regulator. No, actually I had a phenomenal experience at Treasury many years ago. And understand, it's chaos because you're really talking 50 different groups of people, each with their own opinion on how things should work.
Hard to get everybody aligned.
That's right.
Okay, so let's move on to the next topic before we get into You've Got to Be Kidding Me in our main event. This is getting my attention. I'm going to give you a couple of different statistics here. A recent article from Financial Advisor magazine quoted Tiburon Strategic Advisor research showing roughly 2.4% growth if you tease out market returns. An article on the Think Advisor website asked, where's all the organic growth gone? Fidelity just reported in their latest advisor survey, stagnating organic growth among RIAs. Life Yield report noted a decline in organic growth. Schwab's latest benchmarking study showed a 7.1% decline in aggregate advisor AUM. The latest Investment News SEI benchmarking study showed 3.6% net new AUM growth. Okay, where has all the growth gone?
Well, for starters, there was a period where no one cared about growth. Between 2012 and 2021, 70% of the industry's growth was from market appreciation.
Returns.
And one of the custodians did a study of all the guys they were working from and found 70% of them would be shrinking, but for the market. First off, there are firms that are having spectacular growth. And so that 2.4 is not evenly spread across the industry. I know many firms. Like one of the best firms in the industry is Beacon Point, and they've been growing at double-digit organic forever.
Merit Financial out of Atlanta,
Phenomenal.
Georgia. National firm, phenomenal organic growth.
Phenomenal growth. And the way to think of this is that there have been firms that have stuck to their knitting, consistently trying to grow. There was a period of time where you could borrow a lot of money and buy up a firm, and all of a sudden, who cared? The market bailed you out over time. And it was a good bet. People made a lot of money for their investors. But the dilemma is when you stop marketing, restarting that is, unbelievably hard.
Well, most firms have stopped growing and forgot about growth, and so they're banking on referrals from existing clients and pick up a few new client relationships a year. It's a different game to market today than 15, 20 years ago.
Yeah, and I think we discussed this once. If you want to know what the average age of the clients at the firms are, look at the founder's age.
There's a direct correlation between the two.
Direct correlation. And there's so many firms where they've become such easy places to work. Firms that grow at a high rate are not easy places to work. There's a lot of pressure. There's a lot of accountability. It's not let's hold hands and sing kumbaya. It's let's focus on how do you build a business, what are the expectations. If you do a good job, you can make paid extraordinarily well. If you don't, we probably got to get someone else to sit in your seat. Okay,
so if a fee on AUM is our subscription business, and the market's going to grow, and therefore revenues are going to grow, and advisors focused on profitability, dropping 30% to the bottom line, it's a nice paycheck. A whole lot of boutique firms and lifestyle practices are probably just going to set it and forget it. Why does growth actually really matter?
Well, for starters, at some point, your clients rather rudely start consuming their capital. It's not like you have this perpetual cash flow stream out there. And actually, many years ago, we did a study on this. It's a rapidly it's like a double depreciation declining function when they get to a certain age. as they get older, they consume more capital and they also take much less risk in their investments. And it's the combination reduces the fees. But the other bigger issue is, when you think about growth in general, is a lot of the growth that people have gotten has not been from doing traditional marketing. It's been showing up at the custodian's doorstep saying, hey, can you give me clients? Referrals, yeah. And a very famous money manager once described that to me as analogous to cocaine. It may feel good, but if you get addicted, it'll kill you. I think that what you're going to have is you're already seeing this, a have and have nots. There are certain firms out there that are growing at extraordinary rates. WEG, Wealth Enhancement Group.
Off the charts.
Run by some of the most sophisticated people in this industry. Creative Planning, need I say more? Mm-hmm. They're unbelievable. Pure is a firm down in San Diego that is just breathtaking, their growth rates and what they're able to do. And a lot of this it's culture, but it's also, yes, they've done M&A, but everything about M&A has been driven towards accelerating growth, as opposed to simply getting somebody's book of business and saying, "What can I pay a price for that?"
Yeah.
That's right.
So, what do you think a firm needs to grow at just to break even?
Well, again, it depends on what you think labor costs are going to be. And we have an industry that looks like a shrinking geriatric ward. According to Hurley, which we'll see if he's right, 37% of the industry is going to retire in the next 10 years. And
I don't think he's right, by the way.
I don't either. But I still think there'll be a fair number that will go.
Well, we should all go long on oxygen tanks, because I think most advisors are going to die at their desks, and the subscription fee is the real kicker. That's what's going to keep them.
I personally am investing in defibrillators, but I would tell you that I think that when there is an enormous growth opportunity, there are 7 million more Americans that are between the ages of 45 and 60 than there are 60 to 75, meaning this industry is going to more than double in size over the next 15 years, more than double in size. And it's like a giant land grab. The cost of getting clients is a fraction of the present value of the cash flows. Competition at some point is going to change that. So whoever takes advantage of the land grab now is going to win enormously.
Big time in the future.
Enormously.
Yeah. So it's estimated by Tiburon Strategic Advisors that there's $170 trillion of wealth transfer between now and 2045. When you start thinking about the massive tsunami of wealth being transferred, I just think back, remember the old Harry Dent days? The boomers are coming, the boomers are coming. He wrote about Dow 40,000. Everybody laughed him out of the room.
Yeah, not anymore.
Well, here we are, right? So I think about the boomers and what everybody back in the 90s they were talking about. And today, we stand here and look at the wealth transfer as a multiple of what we saw in the 90s.
Yeah, and candidly, if I'm an advisor, I'd worry less about the wealth transfer than just the sheer new wealth that's being created. There, like I said, there's 7 million more people than between 45 and 60 than there are 60 to 75. So there's a staggering number of potential clients to be gotten. In terms of the wealth transfer, the only question I'd have about that is the timing. Mm-hmm. Laura Carstensen, who runs the Stanford Longevity Center, who we talked about last time, utterly brilliant woman. She believes that as you get past 60, your odds of living to 100 go up dramatically. And the two biggest indicators, aside from your DNA, are your education and your wealth. Mm-hmm. So I think a lot of people are going to live longer than people expect, and they'll consume more of the capital. But if I'm a wealth manager, I don't care if there's so many new clients I can go get. And that's what the best firms are doing right now.
Something tells me this is going to be a main topic in a future podcast. You've got to be kidding me. Okay, Michael Nathanson's new post as Focus CEO could create an apparent conflict, double-checked by RIA Biz, with his duties at Colony Group, which is snapping up billions in Focus RIA assets, but partners now have one of theirs in the power seat. Okay, this story is unbelievable to me. I can't even believe it made the news.
Well, let's start with, you do need a power thesaurus to read any of these articles so you understand all the terms. But Michael Nathanson has taken on one of the most challenging jobs. He's the right guy for it, too, which is Focus bought up a lot of firms. They leveraged themselves up like crazy, made a lot of money for their investors, but they really didn't rationalize anything. And Michael has stepped into the breach and is willing to do this. What's absurd about this article is the, quote, apparent conflict. There's no conflict.
There's no conflict.
Come on, that's a smear. Michael, the irony is even the article talks about how people and all the firms are throwing bouquets at him going, thank God we got someone who really understands our business. He's going to find a way to fold us into smaller groups so we can run better. and he's not going to screw it up because he really understands the business. And instead, they're talking about, like, I guess there's some theory that he could game which ones go into Colony versus others to benefit him. I mean, oh, come on.
Well, and CDR is very sophisticated.
Oh, my God. They are unbelievably sophisticated. And Michael's a good guy. I mean, he was a former partner, senior partner at WilmerHale. I mean, we're talking about, this is just, it's outrageous, is what even suggests something like this.
Okay, terrific. Let's move on to our main topic, which is what's really going on in M&A. There is a lot of cash on the sidelines. Some say it's as much as $1 to $2 trillion in assets. There's far less debt available and more costly for those that want to access. It just feels like there's something happening here and that hasn't been reported yet.
Yeah, I think that, as I like to say, it's a bit schizophrenic. You're right. There's just, if PE firms are breaststroking their way through $100 bills, they have $1 trillion plus in dry powder. Plus, the way PE firms raise money, typically they'll go to sovereign funds, and sovereign funds now will only give them money if they also get co-investment rights for equal or even greater amounts of money. And it's a way to cut their fees effectively. So when they say they got $1 trillion dry powder, they probably got to put about $2 trillion, $2.5 trillion to work. That said, there's been a lot fewer deals. Now, part of this is a lot of the mid-sized firms have already been bought.
They've been merged already.
That's right. But the other big issues you touched on is that the real game for 10 years was borrow as much money as humanly possible and buy anything. Who cares about quality? Who cares about anything? Because if the market keeps going up,
roll them up.
Just buy them and let them ride up and paper over all the mistakes and stuff like that. And sadly, the party's over. And not everybody.
The party for just rolling up rapidly.
Just like that. There's still a lot of acquisition opportunities, and there's still going to be a lot of deals done. But today, the market's efficient. There's about 100 potential buyers for every firm. And so you don't make money simply by doing the deal. You make money on what happens after the deal. Yes. That's the real key distinction. And you look at some of the biggest buyers, historically most aggressive buyers out there. Corient, which has bought up easily some of the best firms in the industry, but they paid
a lot.
They were very aggressive, let's put it that way. And they're public companies, so you can actually see what their balance sheet looked like. And they got, so we say, a little bit far out in their skis, so they had to go and raise $1 billion, and they raised it with a Pac-Man bond. It's a PIC bond that means they get paid in kind. They get equity back, and had a 14% coupon. And I don't, it can debate over what the valuation was, but my experience, when you're getting 14%, 1 over 14 is, I think, is 7 times. It's not that high.
Right. So it's not 20.
It's not 20. It's definitely not 30. Now, that said, they own some of the finest properties out there. But what's very interesting is that their CEO hosted a investor call the other day, and he said something. He said that they're planning for an IPO for the U.S. unit, and that it is, quote, fully separable.
What does that mean?
Well, that, as someone who in earlier life worked in M&A, that means for sale.
Yeah,
because look, as a public company, if you're going to IPO it separately, which means you're spinning it out,
signaling to the marketplace.
Well, you're going to get the highest price possible. You have a duty to do that. And if you're a PE firm, you're lining up to see what you'd pay versus the public markets. I argued in this paper we put out not too long ago that being public is, quite candidly, counterproductive to owning wealth management, because wealth management in its core form is organic growth, and organic growth takes a very long horizon as opposed to next quarter's earnings.
Big investment.
Absolutely. Hightower is another big firm that's out there.
Yeah, they didn't get an adequate price and pulled back.
Well, and to be sure, again, the people who backed them, the lead guys, are very smart, but they made a lot of fanfare. They discussed the idea that if we get the proper price, we'll sell this, we'll make our investors whole. All right, if you're a PE firm, you probably got way too much money to put to work. Yes, if someone's willing to pay you an extreme price, you're happy to sell it, but you're more happy to keep collecting management fees. So after a lot of fanfare, we're going to have to roll our investment over. But this has happened again and again and again. I can go through firm after firm after firm that this has happened with.
Well, let's bounce around a bit, because Focus is in the process of rationalizing what it's bought. So what's happening there?
Well, it's one thing when you're out aggressively trying to buy anything you can because you got a currency and you want to spend it. It's another thing when, okay, now we got to put these things together. And by the way, we got to get them growing again. And if you look at Focus's numbers, historically, when they were a public company, if you took out the market and took out acquisitions, they were shrinking. they're kind of a classic example of taking advantage of this tidal wave, and they made a lot of money, so no criticism of that. But now this is Michael's challenge. Michael's got to find a way to first rationalize these, and then you got to reset the culture, because to grow organically, it requires the entire organization to be focused on, almost obsessed about it. If you look at the best firms, that's who grow the most. That's how they actually operate.
So what about like Creative or Mariner or Beacon Point or WEG? What's the difference with those firms?
Well, they never, ever stopped focusing on organic growth. From day one, they've been focused on organic growth. And a lot of this has to do, I think, with their time horizon because of their backers. Beacon Point, that was, Shannon and her father owned that business. Marty, it's his family that owns the business. Peter, it's his business. And they've always thought of, okay, not what is this opportunity now? Yes, we want to take advantage of this. But, okay, when we get to the end of this period, we want to still have something that's great and can continue to grow. And they also recognize that organic growth builds staggering amounts of value. So these organizations from day one have always focused on it. You mentioned WEG. The person who runs WEG used to be in the consumer goods business.
Jeff Decco.
He is one smart dude.
Brilliant CEO.
And this is like a machine, the way they grow this thing. And it utterly focused on constant organic growth, managing efficiency. Every time they've done acquisitions, it's been to facilitate more growth. It's not simply to do the acquisition. I think that CapTrust is another one that's done a very good job of this, quite candidly. But I think what you're going to see is a separation. You're going to have the firms that over the next 3, 4, 5 years are going to grow at astounding organic growth rates. Like everyone's going to go, how are they doing that? And the rest of the industry is going to be like hoping to keep their heads above water.
Well, that said, there's still buyers out there. The firm's getting deals done. First quarter alone, 90 transactions, smaller on average, however, but there are aggregators continuing to consolidate.
Well, of that 90, though, it's a little bit inaccurate in that involves, like when Michael will fold a firm into another firm, they'll call that a deal.
That. Yep.
They'll count. It's already been sold. It's just it's reshuffling the deck. That's all that really is. But to be sure, there are deals getting done. There are many, many potential sellers but what drives deals in the wealth management industry is not economics. It is demographics. Because if you own a business and you run it intelligently, you can sit there and run that forever, literally fly it into the ground if you want to.
So is it this whole transactional approach to the M&A, we've seen for a while multiples continuing to expand, largely because of the flood of this money coming to the marketplace. So if it's true, there's that $1 trillion to $2 trillion in powder and cash reserve. Do multiples hold up?
We argued this in the paper strongly, but we think it's even more subtle distinction. It wasn't so much just the money that's out there. We think the market has finally figured out that the stability of the cash flows in this industry is unmatched anywhere else. I just did an article in Financial Advisor. We talked about this model that we talked about in our last call, which is the getting paid as a percentage of assets model, which I call the greatest possible compensation system ever. And you on average, you get a fee increase that's bigger than inflation. And then, by the way, as they give you more assets, you get paid more money, even though there really is no marginal work involved in that. I think the multiples are being driven by the fact the market has finally woken up to this. Historically, you were talking 8 to 10 times. I really think we're probably 14 to 17 times. And if you happen to have a great firm, it's going to be closer to 20.
And a great firm looks like strong organic growth, excellent next generation leaders, strong profitability, and a focus in on margin compression and really dropping 30% to the bottom line.
Yeah. And the only thing that can kill you in this whole space is cyber. That's the one thing.
That'll wipe you out.
That is the only existential threat out there. Everything else, it's just a question of how successful you're going to be.
Well, I would argue one of the other existential threats, and maybe we'll pick this up in the next podcast when we talk about growth, is where the flows are going. Vanguard, Fidelity, Schwab, and of course, Morgan Stanley with their acquisition of E-Trade and all the stock option business they've got. Otherwise, flows are tough for a lot of firms.
Yeah, again, I would argue the challenge there is less that than the fact that they've been unconscious when it comes to marketing for a decade, and waking up and getting going again is just brutally hard.
All right, so that covers us for today. Again, thanks for time today. It was great catching up with you.
Thank you very much. Really enjoyed it.